Today we're going to be starting off with Professor Yezer from the Department of Economics, who is going to give you an overview of the Federal Reserve System's regional work. Tony.
There's a classic literature on optimal currency areas. And there's 4 conditions for an optimal currency area. Number 1, it's great if areas that form the currency area are subject to the sort of same economic shocks. So if part of the currency area is agricultural and part of it is manufacturing and part of it is research dominated, then you might not think they'd have the same real shocks, right? I mean, travel and tourism and farming likely not to share the same disruptions in terms of their economy, right? Although maybe the same. Foreign travelers are less likely to come to the United States if the dollar is strong, and obviously we're going to export less corn if the dollar is strong. So you do have to think about this a bit, but you want the same real shocks. Discretionary monetary policy tries to offset these real shocks by lowering interest rates and increasing consumption and investment. But real shocks may not hit the area at the same, at the same rate. And so there's a conflict in terms of policy. Right now, Wyoming has what? 3.5% unemployment? Okay. Other parts of the country have 10% unemployment. Right now, housing prices are in the toilet in Phoenix and Florida. Housing prices in Boston, I know because my daughter's trying to buy right now, are not in are definitely not in the toilet, okay? In fact, houses are selling for 10% above the asking price, I found out. Criteria for forming optimal currency areas include labor mobility and migration across areas. We want people to be able to move. Is that true of the United States? Yeah, we're very mobile, okay? People move all over the country. In fact, people are flooding into Wyoming right now. So we'll get a check on that. Capital mobility across areas. Is investment free to move? And the answer is, well, I guess yes. I mean, sometimes it's hard to build a factory, but it's equally hard to build a factory no matter where the investment funds are coming from. So I'll give us a sort of check. Wage and price flexibility across and within areas. Yeah, we have a lot of that. What about stabilization policy? We would like to have a situation in which if a particular area is hit with a downturn, then the taxes that they pay fall and the transfer payments they receive rise. Is that true in the United States? Okay, we have a progressive tax system, right? So what happens if the California economy, despite the fact that it's a very high income area, what happens to tax receipts from California when there's a recession in California? They go down. What happens to transfer payments to Californians? They go up. Oh, well, that's working, right? So the point is that there is a fiscal policy that tends to increase demand in areas in recession and decrease demand in areas in boom. I mean, that is, if taxes go up and expenditures go down, then obviously demand is going to fall. All right, so we have that, right? And similar business cycles across areas would be really nice. Okay, if we take a look at the United States and we apply those criteria to our regions, the similarity of the business cycle is in question. And if you get really narrow, economists doing very narrow economic research on the regional business cycles and their differences, the Southwest, the Southeast are kind of problematic. That is, we do have some systematic differences in business cycles. But overall, the U.S. fits the criteria for an optimal currency area pretty well. And so in terms of the Fed accomplishing its purpose of managing an optimal currency area, it doesn't seem to have major conflicts, okay, with the criteria for an optimal currency area. Again, you know, a lot of banks are getting in trouble in Florida and right now, and obviously, I'm sure the Fed has some issues as to whether or not the discount window at the Federal Reserve Bank of Miami is being absolutely consistent with a discount window at the Federal Reserve Bank in Minneapolis, where things are booming, right? But that's their internal problem. I haven't heard, even from the rumor mill, that there's a great difficulty or concern there. Now, let's apply the criteria to Europe. Whoops. None of the 5 criteria fit particularly well. Okay? I know that labor and capital mobility in Europe are increasing, but they're not that great. Mobility within labor markets, even within European countries, is a problem. My question is, why do ballerinas in, oh, I don't know, France, qualify for retirement at 45? Now, there'll be an obvious reason, but then you have to think about it. Ballerinas in the United States don't qualify for retirement any earlier, right? 65 is our expectation. Well, going up, whatever, but don't qualify. Well, gee. Now, there's an obvious reason why 45 is getting there for ballerinas, right? Because of the physical demands of the position, as well as the injury factor, okay? I mean, gymnasts, for crying out loud, you know, if you're 25, you're lucky, given the physical demands and the injury factor. But why is it that the Europeans need to have retirement for ballerinas at 45? You think about that? See, the devil's in the details. Yes?
They can't get another job.
Bingo! Excellent. They can't get another job. Right. There's such terrible labor market mobility. Look, in Italy, once you get a job, after 1 year, you're either up or out. Okay? If they keep you after 1 year, in your first year you work for almost nothing, they keep you after 1 year, you get a contract which entitles you to 3 years of wages if they ever get rid of you. So you have 3 years of full severance pay if they ever get rid of you. You can imagine how an Italian firm feels about hiring someone who's lost their job at 60, right? Probably not very good, okay? This is not a very good prospect. So there's massive problems with labor market mobility and crazy rules in Europe that are even within countries, and then between countries, labor mobility, even if the people are willing to move when they're young, is very problematic. So basically, Europe really doesn't fit the criteria for an optimal currency area. I mean, can you imagine running a monetary policy for the Germans and the Italians? I mean, can you actually imagine having a party and inviting half Germans and half Italians? Okay? All right. Is this really, is this going to go back to, all right. All right. Well, anyway, there, I know some, no, I actually, all right. So that's what I have to say about, so that's the first thing about the Fed's regional policy. We're lucky in the United States. We happen to blunder into this currency union, and in fact, we have a currency union. Part of the reason we even have as many Federal Reserve banks as we have is Professor Bernanke talked about the issues of regionalism even in the monetary standard. And we had the West, you know, Colorado's had mining all this silver, and other areas were mining gold, and you know, and they were worried about the banking system being captured by New York. Okay, well, those problems are long gone. We're very lucky we have an optimal currency area that makes sense. All right, I'm going to talk a little bit about the crisis here. And the first question is, have we been here before? Hegel, right? The only thing we have to learn, the only thing we learn from history is that we don't learn from history. So, have we been here before? Have we learned nothing? Maximum of economics is that incentives matter, and the devil's in the details. So what we have to learn is about details, and my gosh, people really don't deal with details very well. Okay. My notion is, and not only that, in economics, the notion is that, in fact, details are very important. Incentives matter. The way we relate to each other. So for example, the rule that you have to pay workers 3 years' wages if they leave makes a huge amount of difference in the European labor markets. Okay? Huge amount of difference. That's just a little detail. So I have this idea. I use the term mousetraps. The idea of mousetraps in complex systems you have to watch out for. I got that idea from a Laurel and Hardy movie. Basically, Oliver Hardy was the big fat one. And Stan Laurel is a skinny one, probably smarter. So Stan noted mice in the kitchen. So he put mousetraps around the kitchen. I guess he didn't tell Oliver. So Oliver's in the kitchen, and you know what's going to happen, right? He puts his hand on one mousetrap. Bang, it springs. Oh, he shrieks in pain. Puts his hand. Oh, he hits another mousetrap. He staggers over here. Oh, he steps in a mousetrap. Anyway, he's got like 5 mousetraps on him, right? Before Stan comes in. And then obviously, you know what happens. Oliver tries to catch Stan and beat the crap out of him. But Stan is too fast. So anyway, at one time, that was actually, we thought that was funny. And we used to kind of watch that and laugh at it. I know nowadays, you've got the Kardashians. So that's fine. All right. Anyway, I still watch Stan. Okay. So the distinctive thing about mousetraps is they sit there. I want you. This is a metaphor that's there for a reason. They sit there. And society can function with a mousetrap. Fine. But then when one springs, they spring others, and you have catastrophic failure. The conclusion is rid the world of mousetraps, even if they've done no harm recently, right? So you know, in your dorm room, well, I just noted actually that this was Alabama. They had the Crystal Trophy for winning the national championship of football. And I don't know, they were tossing it around or whatever, or they sort of put it on the edge of something, and it fell off and crashed, and it was $30,000 worth of Waterford Crystal. The news reports, that just happened today, and they didn't say whether it was insured. But see, probably not a good idea to put the national trophy down. You know, maybe a case that's attached to the wall and closed would be a swell idea for Waterford Crystal, right? Okay, especially at the University of Alabama, all right? Especially with the offensive linemen. Okay, that's why I say attach it to the wall, because if they bump into even a normal cabinet, it's goodbye cabinet. All right, so you get the we want seriously, we just got to avoid these things. You're going to say, well, it's all right sitting there, it hasn't fallen yet. You say, yes, I know, but why take the chance? Okay, get rid of mousetraps. Okay, so with that as background, let's see, if we've been here before. Oh my goodness, in 1991, the value of land in Tokyo was larger than the value of all the land in the United States. Wow, that sounds pretty good if you owned land in Tokyo, huh? Yeah, at that time the Japanese bought Rockefeller Center, Pebble Beach, they were buying everything. If you owned land in Hawaii, you had to actually post not for sale signs to keep Japanese realtors from knocking at your door and annoying you. Okay? Yes, exactly. Wow, good. Oh, excellent. Or is that a little strange? Why were land values in Japan so high? Oh, a little mousetrap. The Japanese tax on capital gains on land were almost confiscatory. They had a 95% tax on capital gains from land. So nobody sold land. In fact, if you looked at Tokyo, they had a core of a few really tall skyscrapers. The density fell, and then the poor people in Tokyo had to ride a train for 25 miles. The land market was totally distorted. You had no way to assemble land. Why? Because they had a confiscatory tax on land. So the few land sales that happened in Tokyo were at enormous prices because there was no land to be gotten any other way, because nobody wanted to sell. Well, the Japanese realized this was a problem. What to do? Well, let's lower the tax rate. The problem is when they lowered the tax rate, what did everybody do with their land? They sold it, sure, even thinking this was temporary. They dumped all the land on the market. Land values crash. All the banks that had made loans based on those high land values, guess what happened to them? It wasn't pretty. Mousetrap. Mousetrap. Yeah. See, professional economists can see the relationship between a confiscatory tax on capital gains on land and mousetraps and a terrible financial collapse. But it's only professional economists. The Muggles have no clue. Oh, people who don't know economics, I call them Muggles. Okay? Yeah. I understand there's this Rawlings woman who also has used the term and made a lot of money out of it. And you know, I'm the kind of guy that it doesn't bother me at all. Okay, by the way, tell her that I'm not making any money on it, so don't go after me first. All right, but yeah, I love, by the way, I understand recently that there was some unpleasantness because Goldman Sachs called their clients who knew no economics muffins.
Muppets.
Oh, Muppets. I thought it was Muppets.
It's a British term for like stupid people.
Right, people who don't know economics. Exactly. No, it's really, okay, but they're talking about people who don't know any economics. And yeah, a lot of their clients, you know, that's why it's really a good idea if you have fee-based financial help if you don't know any economics, okay? And if you don't get fee-based financial help and you go into markets with huge amounts of money, you just have, you know, why just put a sign across your back, kick me. I mean, fine, that's your approach in life. Good. You know, hey, well, you buy medical care, you have know nothing about medicine. Great. You know, buy the ground up peach pits that cure cancer. That's a swell idea. No, that's why you have fee-based help in the world. Okay, anyway, enough of that. So the point is mousetrap, big mousetrap. But you understand how it takes a professional economist to see the mousetrap. And Japan is still suffering to this day because they didn't do a very good job of recapitalizing their banks. Okay, let's look at something else. This is from Bill Wheaton at MIT. These are his slides. Look at the correlation between economic recessions and housing production. Okay? You see the housing starts in red. Oh, wait a second. Oh, look at this. Oh, it was one little period here where we skipped. Okay? This is a .com thing that did that. All right? But other than that, looks like there's some relationship between real estate and cycles. Professor Bernanke talked mainly about 1930s, but the point is this is a general trend. Here's house price changes in recessions. Okay? Looking good, except for the .com. But we're making up for that now, aren't we? Woo! Making up for that now. So look like this, yeah. Gee, we've been here before. Yeah. The definition of insanity is doing the same thing over and over again and expecting different results. Do we do the same thing over and over again and expect different results? Why isn't this shown to the American, the Muggles? Right? Why is this even news? I don't know. Very interesting. Okay. Have we been here before? Continued. In 1972, FHA had a special Section 235 lending program, encouraged home ownership with very low down payment, even extraordinary. And also they kind of waived the property inspection and things like that. Actually, it started in '68, but in any event, the program. Well, the insurance fund experienced very high defaults rates, huge losses, and the special risk insurance fund, went way into the red. Mousetrap, right? Yeah, it's kind of lending with low down payment with no property inspection is just, okay, it's not muffin, it's a Muppet or a Muggle, whatever. Hey, how about 1980 to 92, the thrift industry crisis? Savings and loans, Fannie Mae, Freddie Mac, Yeah, they were all set up to provide cheap credit for housing, right? In fact, there was an elaborate interest rate ceiling scheme that channeled credit through the savings and loan industry to mortgages nice and cheap, right? With 30-year fixed rate mortgages. Big mousetrap. Interest rates rose. Lenders became insolvent. Supposedly, we set up reforms so that this will never happen again. Right. Okie dokie. Another mousetrap. So what do we learn from history? Well, we learned watch out for mousetraps. Mousetraps are hiding in the details of the kind of contracts we have, the way we're organized, and the tax system. Muggles love mousetraps. Mousetraps are likely to be hiding in the details of the mortgage and real estate markets. Otherwise, we wouldn't see what we're seeing, right? We wouldn't see that they lead us into recession. Must be some mousetraps there, right? Yep, probably are. Okay, so we've learned from history, right? So now we've got some reform ideas. Reform idea number one, Muggles in the mortgage market, reforming expectations. What do Muggles expect the mortgage market to do for them in the United States? Here's the expectations in the United States for what the mortgage market is supposed to supply to you to ensure the American way. 30-year fixed rate mortgages, no prepayment penalty. It means if interest rates happen to go down, you can refinance, right, without a penalty. Of course, that means the gain from the gain from the higher interest rate on the mortgage is lost to the lender. If interest rates go up, can the lender call the loan? No. Okay, no, the lender, if interest rates go up, too bad for the lender. There's no deficiency judgment in case of default. That means basically, unlike most of Europe, where if you default on a mortgage, they can pursue you and take your car and your villa in Capri and garnish your wages. In the United States, you default, you just leave. You know, put the keys under. As a matter of fact, you can even trash the house, right? So take the refrigerator, freezer, and any other appliance you like and just move out and leave it. No consequences. Oh, let's make it take 2+ years to foreclose on defaulted properties. Oh, great. Yeah. Oh, there's mean foreclosure. Oh, my gosh, foreclosure. Ah, they had someone sign a document which was perfectly legitimate without reading it. Wow, that means it would take another year, okay? Oh, and let's have a loan-to-value ratio of 97% or more. That makes sense. Payment to income ratios of 40% or more. It means your monthly payment for the mortgage is 40% or more of your income. That makes sense. Hey, how about lending to borrowers with credit scores less than 600? So they actually have past charge-offs for things they didn't pay. Oh, yeah. And by the way, price it at the Treasury rate plus 200 basis points. That means 2 percentage points above the Treasury rate. Oh, that's the product that the American people insist on being given to the American people to be fair. If we don't do this, we're not encouraging home ownership. Oh, my goodness gracious, can't do that. Let's take a look at the typical FHA-insured mortgage. By the way, FHA is underwater now also. It's just the accounting reality will catch up with it. It'll probably cost us $50 billion eventually. Okay. Anyway, certainly the losses on the existing portfolio will be in that range. Okay, so FHA, oh yeah, sure, has a 97% loan-to-value ratio. 97% loan-to-value is 3% down payment. 3% down payment means that the asset value of 100 divided by 3%, 100% is 33. It's a leverage ratio. Leverage ratio is the asset value divided by the equity. That's 33. Here's a quote from CNN Money on the financial crisis from March 2010, but there's lots of these. If an investment bank has a lower leverage ratio of 30-to-1, a drop in asset prices of 3.3% will basically wipe it out. Surely we've learned that all asset classes are at risk for distortion in liquidity, the magnitude of which could far exceed 3.3%. The combination of over-leverage and undercapitalization magnified the risk to our financial system and will continue to do so unless leverage ratios are capped. oh my gosh, investment banks actually had leverage ratios as high as 30 to 1. It's our government policy to have leverage ratios of 33 to 1 for home buyers. See, to an economist, this seems to make no sense. This seems to be logically inconsistent, right? To Muggles, it seems perfectly consistent, right? Yeah. The car of this economy is being driven by Muggles on drugs, basically. Right. Yeah. Look at the other European economies. We're not far behind, folks. The problem is Muggle expectations of the mortgage market. They expect a mortgage product to be delivered that is unsound and is a mousetrap. The basic mortgage product that the Muggles and their politician representatives think that the American people have a right to is fundamentally unsound. Whenever house prices drop suddenly or interest rates rise rapidly, these mortgages experience huge losses that decapitalize whoever holds them. Private investors will demand a mortgage guarantee to hold these unsound products. The private mortgage industry, by the way, retreated rapidly from the mortgage market. And so we're left with Fannie Mae, Freddie Mac, and FHA, or banks that are too big to fail to be the ultimate investors in unsound products. You understand, okay? The American people demand that the financial system provide them with a product that's fundamentally unsound and will experience massive failure. The private sector then demands that if they're going to invest in that, they have a government guarantee. So we can go along for a while, and the government guarantee is actually earning money. That's fine. But then whenever something bad happens, we have a massive failure. It's a mousetrap. Okay? It's a mousetrap. Have we learned anything about that? No. Have it? Well, I could go on. But we've just learned nothing. Okay, nothing. Okay, next is deposit insurance. So, because after all, we have, obviously Fannie and Freddie are an issue. By the way, Fannie and Freddie are, of course, an issue of government guarantees and FHA also. But then we have deposit insurance for the banks to hold these products. Okay, as Professor Bernanke said, deposit insurance is a swell way to stop the Muggles from running on insolvent or illiquid banks. Yep. And by the way, stopping bank panics is good. I'm all in favor of not having panics. Of course, the question is, what do you do with the insolvent banks, right? The fact that the people aren't running on them doesn't eliminate the problem. All you've done is provide a guarantee, right? Hey, why don't we provide flood insurance for people who build houses right up to the water's edge? Then they won't get frightened and panicked when a hurricane comes, will they? That's swell. That solved the problem. Muggles think so. Used to be, by the way, you could actually call up and get flood insurance within 12 hours. Can you imagine what people did? Okay, yeah, you talk about adverse selection. At least we stopped that. FEMA, you can fool FEMA some of the time, and you can fool FEMA all of the time, but, oh, okay, well, where do I go from there? All right, I'm going to drop that line of thinking. Okay, hey, does deposit insurance change bank failure? Do you think insurance changes your behavior? If you were personally liable for everything, let's say you're driving your car, you knew you were going to be personally liable. Is that going to change your behavior? Yeah, perhaps. See, this insurance thing is very interesting. I mean, economists look at it this way. Parachutes are a swell thing to have when you bail out at 10,000 feet. I recommend them, absolutely. But then the question is, how many people would be killed skydiving if the parachute had not been invented, compared to the number of people killed skydiving today? Oh, guess what? Right. I mean, we have research showing when you make automobiles safer, you get more pedestrians hit, right? Because people drive faster, okay? And you get more collisions, right? Yeah, there's nothing like having this collapsible box. You know, we show you, my gosh, we drove 60 miles an hour into a concrete wall, and the crash dummy survived. I say, great, but the problem is don't show that to the idiot driving behind me, all right? Because they're going to think that they, you know, when I stop, that they don't have to, okay? Especially if I've irritated them in some way by actually kind of like driving at the speed limit or some other socially irresponsible activity. All right. You begin to see a little difference in the thinking of economists and muggles about this insurance thing, right? All right. So, yeah, with no banking panics to discipline risk-taking by banks, what will we do when they become insolvent? See, there's this moral hazard problem. If a bank is insolvent or nearly insolvent, it has nothing to lose by taking risk. Banks do something called, the jargon terms for this is gambling for redemption, by lending more and taking added risk. I mean, if you think, look, if you have borrowed money from the fellows in the dark shirts and light ties and you went to the races, okay, and you borrowed $1,000 and you bet money on the first race and lost, the second race and lost, the third race. Okay, it comes the 10th race and you're 0 for 9. So you've lost $900. You got $100 left. They're waiting for you outside the racetrack to be repaid. Now, you can bet on the favorite at 2 to 1, speedball. Or you can bet on Limp Along, who is heavily taped, but appears spirited and willing at 30 to 1. What are you going to do with your $100? See, the problem is if you come out of the racetrack with $200, they're going to beat you up anyway, right? Yeah, you see how your attitude towards risk changes fundamentally? And all of a sudden in banks, instead of banks being prudent lenders, they become imprudent. Yeah, this is called gambling for redemption. We have a jargon for it. By the way, banks that are insolvent, we call them, firms that have low levels of solvency are called zombies. The reason is because they not only are unsound, but their unsound lending tends to drag other banks down. Sound banks are dragged down with the unsound banks. By the way, this happened to Fannie Mae and Freddie Mac in the 1980s. Okay? They were both massively insolvent in the 1980s. Oh, I didn't know that. Well, yeah. No, nobody tells you that. This isn't the first time that they've been massively insolvent, folks. They were massively insolvent in the 1980s. The government was supposed to produce an annual report on the solvency of Fannie Mae and Freddie Mac. Stopped producing it in 1979. The required annual report to Congress. Strangely, yeah. And all they did was gamble for redemption and doubled and tripled their portfolios. And it turned out that interest rates fell and the economy recovered, and they managed to recapitalize themselves. Yeah?
Isn't gamble for redemption still a problem without deposit insurance? Isn't there still...
Excellent question. That's my next slide, Michael. Excellent question. Okay. How does debt discipline borrowers and prevent zombies? All right. So I have a little graph here. Here's time. Here's a financial firm that initially was in great shape. It had this much debt. Could be deposits or any kind of debt, right? And here's the value of the firm. So the difference between the value of the firm and its debt is its equity, right? V minus D is the equity of the firm. It's looking quite good here. I'd say the leverage ratio is maybe 3, right? Equity is 1/3 of value, maybe less than 3, 2.5 here. But, stuff happens, right? Stuff happens. Okay. What happens with lenders who are not guaranteed. If the debt is not guaranteed. If the debt doesn't guarantee, you get to here and the lenders refuse to lend and they create a crisis for the firm. The firm never gets to here because without the ability to roll over its debt, it'll be shut down by the lenders and they'll have to file for bankruptcy. That's how the market stops gambling for redemption, by lenders cutting you off at the knees. It's called debt disciplines. Notice equity doesn't discipline, right? In fact, here equity is negative. So here, if you guarantee the debt, the firm continues to operate as a zombie. And it'll gamble for redemption. And hey, in the case of Fannie and Freddie in the 80s, they managed to gamble for redemption and grow their, why? Well, why could they grow their portfolio? Because their debt was viewed as government guaranteed. So everybody said, oh, of course, yeah, lend to them. Right? And maybe you can, quote unquote, grow your way out of the problem. That's what actually one of their chief economists at that time was my former student. So in any event, so they were going to grow their way, and they did, they did. Too bad, because now they've stuck us with, maybe $300 billion in losses, right? Yeah, but it's a mousetrap. I mean, this whole, that kind of lending, whatever, with mortgages that you only make because of a government guarantee, it's a mousetrap. Sooner or later, you'll get stuck. Okay, it's only a matter of time. But Muggles love mousetraps. Okay, you see the difference. When the debt is guaranteed, nobody shuts them down. Yes?
So in this year, the lenders refers to the depositors.
Yeah, right, the depositor. Yeah. Right, exactly. Depositor shuts you down. Or in the case of an investment bank, whoever's providing them with credit. Right.
Do you think that average American depositors have the information to? Well,
not today, no. But remember, this doesn't happen because of the average depositor. It's a sophisticated depositor that shuts them down. Right. I mean, we have this with American Airlines. Why are our firms in bankruptcy protection? The ones that are in bankruptcy protection is because, they're being shut down. I mean, I'm not going to shut down Bank of America, okay? But Bank of America has huge corporate depositors that'll shut it down. I mean, who sets the price of Dow stock in a sophisticated fashion on the New York Stock Exchange? Me? What, with my mutual fund? No, even maybe my mutual fund manager, but there are big investors who, believe it or not, pay a lot of money to follow the prospects of Dow and to price the stock accordingly. And I just ride along with that. I mean, this may shock you, but that's what happens in all our markets, right? I mean, I have no idea what this tie was worth. I bought it in a competitive market, right? And so, and I'm a repeat customer. And so I assume I got a reasonable price because that price was set by people who know something about fashion, which clearly, I don't. Okay, so we rely on that all the time, right? All right, and if you are as big, if you are as big as our big banks, I assure you, you have plenty of big depositors who know how many beans make three. Now, we sometimes have a problem with a little mom and pop country bank. Maybe with people having no clue, but they're not shutting down the economy, right? I mean, it's just like the restaurant fails, right? So a mom and pop bank fails. By the way, I'm not trying to say what I'm trying to say is deposit insurance as currently constituted is a major problem. I always have told my students that the United States came up with two great inventions during the 1930s. One was the atom bomb, and the other was deposit insurance. In my view, in the long run, deposit insurance will probably do more harm. Because it's spread all over the world, okay? And everybody loves it. Muggles love it all over the world, okay? And it can really lead to financial crises because no one disciplines the banking system, right? You understand? And that's bad, okay? That's bad. By the way, this isn't just my opinion. There's a huge economics literature on this is a problem, including the issue in developing countries, from the World Bank and what have you. Okay, so possibly we want to do something about deposit insurance. Do we at least price deposit insurance based on risk? And what would it imply to do that? Well, I actually gave you reading, which is pretty approachable since it's basically from the Economic Policy Review of the Federal Reserve Bank of New York. I mean, clearly a bunch of marginal subversives there, right? No, this is the Federal Reserve System, okay? I mean, you can read the publications of the economists of the Federal Reserve System and see what they have to say about, you know, our financial system. It's not pretty. So anyway, systematic risk and deposit insurance premiums. Are the deposit insurance premiums reflective? Okay, I maybe make a point about this systematic risk. Deposit insurance is insuring the banking system of the United States. All right. There's a difference between thinking about pricing insurance when you're insuring the banking system and maybe just insuring one single bank. Okay? Let's say you're insuring one single bank, and that bank held only one risk asset, right? Wow, that bank isn't well diversified, you know? You'd really worry about that, okay? And it's taking a lot of what we call unique risk and things like that, and what have you, and you know, fine. And you would, you know, you might set an insurance premium high, you know, a little bit higher for doing that, and that would be the way you'd think about insuring that bank, okay? But what if you have an entire system of banks, and now they're all holding the same risk asset? That's very different, okay? Because now you're insuring an entire system. It's not just one bank that's going to go, it's all the banks that are going to go. And you need to price that accordingly. Do we price deposit insurance based on systematic risk of the banking system? No. We don't even price deposit insurance based on risk of the individual banks. I actually have this notion that we just don't do very well with risk-based pricing by the government at all. It's somehow regarded as unfair. I mean, imagine, you know, in our society we have no problem at all that automobile insurance charges the young men in the room a lot more than the young ladies in the room, right? Now, what if they charged the same rate? Okay, and let's say, just to be fair, we lowered the men to the ladies. Because that's always the notion of fairness, right? Remember when they had the cases for the cleaners and they charged the women more than the men? So the idea is the cleaners should lower the price for women. Why not raise the price for men? Oh, it's hard to get a political coalition behind that kind of. So the Muggle thinking is always, okay, so we lower the interest rate for young males to the young lady price. Other than the fact that, you know, that might affect P&L for the insurance industry, can you imagine that perhaps I'd be even more scared when I drive on the Beltway, thinking that there is a bunch of young men who are only paying the young woman price to ram me, okay? And what if you didn't raise the fee when they rammed me, based on your record, right? Oh my gosh. I mean, we don't have any problem with, you know, in general, credit cards using credit score to charge different rates, but let the FHA, gee, can the FHA charge a higher premium because your credit score stinks? No, we can't do that. That's unfair. The Muggles. Yeah, no. I don't know any area where the government sets risk premiums that have anything, you know, where it runs insurance programs, it sets risk premiums that have anything to do with the underlying risk it should be setting. The problem is there's no way to explain this to Muggles, right? I can explain it to you, you know some economics, blah, 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 and I've got your attention, all right? If they call me up, you know, on Bloomberg and they ask me to explain this, you know, they give me like 8 seconds of airtime. They just make me feel, you know, appear to be a fool, right? Oh, well. You know. Or, you know, I can say something disturbing like, you know, that you're not pricing insurance efficiently, but no one will know what that means. So Hegel is partly right. Muggles do not learn from history. And they vote. That combination is not very cheerful. Okay. So what do I conclude from all this? I conclude we have lots of mousetraps, and we've learned nothing about them. And we're going to continue to go on. And this will repeat itself, because we've done nothing to do with it, nothing about it. But what is consumer? Oh my gosh, consumer protection. Oh my, blah, blah, blah. I mean, this has nothing to do with the points I'm making here. Yes?
To kind of follow your line of thinking with how the market without deposit insurance would close down banks by institutional depositors moving their funds and keeping them honest. If you're not an institutional depositor, if you're just a regular person, why would you put your money in the bank? Because the institutional depositors would drive the bank out of business before you could get in. Why would you?
Well, I didn't recommend wildcat banking deregulation. I think if you ask, I mean, I'm with the group of economists who may be the majority that just say, look, we ought to have core bank. Oh, by the way, the other thing the Muggles want is they want a bank that's going to pay them interest on checking, interest on CDs. That's significant, right? They want a brick and mortar building to go to. They want all their checks to clear, and they want a smiling teller to greet them, right, when they walk in. Yeah, right. Okay, they want all that. Well, that's not a bank that's going to put all its money in T-bills. You understand, okay? It can't do that. No, so what economists say is, look, we'll have deposit insurance for something called core banks. Core banks take very little risk, okay? They put their money in very secure investments. If you want a checking account, you get it. You probably have to pay for it. Oh, I have to pay for it. You want a CD with them? Yeah, you'll get very low interest. You want the smiling teller? You may not get the smiling teller, okay? You want the bricks and mortar bank? I'm sorry. You know, you may have to go to an ATM in a grocery store, because that's what you're paying for, Muggle. And then you'll have an institution that can operate securely and maintain all the deposits of Muggles, right? And also of a lot of businesses and things like that. And then everybody else is a broker-dealer, right? So you have, you're a broker-dealer. Yeah, that's basically the kind of proposal. By the way, of course, if you look, you'll see this is all being discussed currently, right? There's all these people who are talking about, all the economists who really like core bank as a proposal. I mean, not only did we not change anything or learn anything, but we don't even discuss solutions in this country. Yes?
Will the core bank still provide liquidity and provide loans and home loans and things like that?
No. Home loans would oh, okay, it depends. Really well capitalized home loans, yeah. Yeah.
But otherwise,
loan value ratios of 0.7 are not a problem. Okay, mortgage-backed, and they'll buy mortgage-backed securities of really, and everything else will be provided by investment bankers and broker-dealers. I'm telling you, understand, the idea is what the Muggles want is, you can't have that. Or the price you pay is we're just going to do this over and over again. Look, I mean, this is like dealing, with Tubby, right? Who wants to lose weight, okay, but doesn't want to go to the salad bar or get on the damn treadmill, all right? And what do you say? Well, okay, then you're going to stay fat, Tubby. And that's fine. This is going to happen again, right? Yeah, and it hasn't been pleasant. You guys have the most to lose, right? I mean, not me. And besides, if you're a professional economist, you just get ahead of this, right? And you actually make money out of all this. Okay?
Have you done that out of the
Yeah, I actually consult for a number of big banks, so yeah. Yeah. All right. Anyway, so there's that. And okay, some other points. Okay, so I'll go on to some other points here. All right. Urban myth. Oh, exotic mortgage products cause a crisis. The fact is, default rates on all mortgage prices just rose in proportion during the crisis. This is not exotic mortgage products. Low documentation loans were only offered to borrowers with good credit history or who made large down payments. Okay? There's basically layering of mortgage risk, and the dirty little secret is there's 3 pillars of mortgage risk. One is income, one is credit history, and one is equity in the property. You can, any 2 of those are fine. Okay, any 2 of those are fine, especially with a wink and a nod, right? I mean, I assure you, I've questioned cases and I've been told, oh, he's good for it, he's an organized crime. Okay, the loan officer just put a note in the file. So don't worry about his income, right? It's fine. Right. Small businessmen, come on, they're not going to declare their income, right? So, yeah, sure. No doc, whatever. Don't worry about verifying income. Yeah, there's a lot of that. That really isn't. It's when you have all 3. Remember I talked about the mortgage product? And I said they want low FICO, high loan to value, and high monthly payment to income ratio. The 3 together. Bernanke had a slide there where he had, oh, this advertisement for the bank. You say, oh, well, you don't have to document your income, and you can have low FICO score, and you can have high loan to value ratio. Yeah, they advertise all that, but you couldn't get them all in the same loan, which is a suggestion he gave, because probably his staff told him that. That wasn't a product that was offered, unless that was a wild exception of a firm that was actually like these firms that say they'll teach you how to pay off a 30-year mortgage in 2 years if you just send them some money. Hey, 30-year mortgage for $100, you can pay it off in 2 years. And you heard that from me, and I didn't charge you for the advice. Yeah, the mortgage balance is low enough. I don't care if it's a 30-year mortgage. You can easily pay it off in a short amount of time. Okay, don't pay for that. But in any event, no, the system wasn't doing that. Okay. Now, there was a lot of mortgage fraud by organized groups of borrowers, appraisers, and loan officers. The FBI, go to the FBI website and just look for the mortgage fraud page, and they'll tell you, yeah, there's a huge effort of organized crime that poured into the mortgage market, and that was a bit of a factor. But the major thing is that just the normal mortgages that everybody expects the government to make, were a problem. Fannie and Freddie didn't lose $300 billion on exotic mortgages, okay? Can you consider that? Yeah. Nope. All right. Another myth is lenders and investors were naive. Oh, they didn't know anything. No, they hired geeks like me to advise them, okay? No. In fact, the private MBS market, the CMBS market, was really new and sophisticated system. It was the most sophisticated system that's ever been set up. Nobody ever told you that, did they? Did you? Ordinarily, before the private MBS and CMBS system, Fannie and Freddie and FHA would take packages of mortgages, put them together, and give you the average characteristics of the mortgage-backed securities. So they say, okay, here's this mortgage-backed security is backed by the payments from 50,000 mortgages, the average loan-to-value ratio is so-and-so, the average monthly payment to income ratio is so-and-so, the average FICO is so-and-so, and they come from the following states. That's all they would tell you. And then the market had to value them, okay? And there's a whole literature on Fannie and Freddie cheating on this and trading in their own securities, and because they would have the information in-house. And Fannie and Freddie swear that they never traded on the inside information because they knew all the information about the mortgages inside Fannie and Freddie. Okay. I know FHA did the cheat because they run everything through Ginnie Mae, and they only have like 7 people. It's just nothing to it. No, that's good. That's good. That's the way Fannie and Freddie. Yeah, Ginnie Mae is a marvel of mortgage securitization. It costs almost nothing, because it shouldn't cost almost anything to securitize mortgage with a government guarantee. Come on, right? That's like my selling gold for $1,500 an ounce. How hard is that? Right. So if I sell it for $1,500, I ought to, shouldn't be hard, right? Yeah. Okay, in any event, no, actually, what happened in the CMBS and private label MBS market is loan performance arose. Loan performance gave you data, and this is a wonderful research opportunity for us, on every single mortgage that was packaged together. Gave you all the underwriting information. Not only that, it updated the payment information every single month. and it updated the FICO score. It was vastly more sophisticated than anything else in the world has ever been available to price mortgages. Oh, we didn't know that. No, it's just a bunch of naive blah, blah, blah. No, this was extremely sophisticated, okay? And rocket scientists, statisticians were analyzing these for prepayment risk and collateral risk, okay? Yeah, this was an extremely sophisticated system.
Did all the investors look at these analyses like every month? Because wouldn't they have seen the problem as their statisticians were saying we're looking at all the underlying mortgages?
The answer, okay, and the answer is all the investors, well, maybe not all the investors, but if you were a significant investor and you didn't at least have an advisor who was looking at this information, you're a fool, right? I mean, yeah, so people would sell the advice. No, there was an elaborate system. It was incredibly, these are all PhD statisticians and blah, blah, blah.
It was too complicated.
I don't know what to say to that, but it's much more sophisticated than the, it's much more sophisticated than any other MBS market we've ever had, any other in the world. And there's always a problem, of course, right? There's always a problem in evaluating the risk of a new class of securities. Because the way we evaluate the risk of a new class of securities is based on experience with those securities. Since we didn't have experience with those securities, there was simply an element of evaluation risk, okay? I also believe that some of the statistical models had problems that people didn't realize, all right? That's the object of kind of really sophisticated high-level research that we needn't get into. My point is simply that the notion that, oh yeah, this was naive and wild risk takers and oh my gosh, what are they doing plunging in here with no clue? It was just the opposite, okay? And what attracted people was they said, this is the most sophisticated market in mortgage-backed securities that has ever been set up, okay? It makes the Fannie and Freddie MBS and the FHA Ginnie Mae look like kindergarten work, because all they give you is a few averages. This would tell you, and you could follow the loans as they defaulted or prepaid, and you could tell the loans that were left in the portfolio, and you had the payment history of these loans. It was an extremely sophisticated market. Yeah.
This is a broader question, but do we really need a MBS market? Because why can't we have banks giving out mortgages to people and holding the mortgages? It seems like
Oh yeah, we could go back to we could go back then we go back to before the Great Recession. There's a reason for that.
it seems like
Let me give you the reason.
It's
The problem.
unnecessary financial innovation that doesn't seem to be achieving that much. It backfires.
Yeah, we can go back to It's a Wonderful Life, and we can have the thrift institution make all its loans for mortgages in the local community, right? Fine. So all its assets are local mortgage loans. I'm sorry, all its assets and all its liabilities are local deposits, right? What happens when the local economy turns down? Oh, gee, people stop paying on their mortgage, and they want to withdraw their money from the bank, right? What happens to the bank? Becomes decapitalized. It's a huge mousetrap. Securitization gets you around the geographic risk associated with the local bank. No, the last thing we want. Oh, I mean, the Muggles think it's really wonderful. Let's have a commodity credit union. Oh, we're only going to lend to coffee farmers. And we'll know everything about coffee farming. And we'll raise as liabilities the deposits, and the coffee farmers will deposit their money in our coffee fund, and then we'll lend to the coffee farmers to finance their whatever coffee farmers have to finance, and that'll be swell. And as long as the price of coffee keeps rising, it is swell, but it's a mousetrap. When there's a serious fall in the price of coffee, the coffee farmers can't pay those loans, and they try to withdraw their funds from the bank. the bank fails. The coffee. Okay? Specialized lending are a disaster. Okay? Specialization in lending is a disaster. Now, it's fine. I mean, you can have a bank that does nothing but lend to coffee producers, but then it has to securitize those assets and sell them off. You can't have the debt of coffee farmers as your liability, and the assets of coffee farmers as your the liabilities of coffee farmers as your assets. That's a disaster. Okay, and that's why we used to do an average of 350, 400 bank failures a year, even in a good year in the United States, because we had all these small banks that were doing the specialized lending. Right.
It seems
I could, by the way, I mean, don't even get me started on Farmers Home Bank. I mean, no, the Muggles think this is all swell. You understand, Muggle? Okay, here's a rule. Talk to people who don't know economics. Invert everything they say, and you'll have something that makes sense. Now, that's the general rule. Okay, you understand, they get everything wrong. They have everything backwards. Okay, everything backwards. Seriously. It makes perfect sense to them that, as I say, if you have a farm, oh, by gosh, let's have all the rice farmers get together and we'll have a cooperative for rice farmers, and that'll just lend to the rice farmers, and then it'll take their deposits, and it'll really get to know the rice farmers, and they can have picnics, and then what do they serve at the picnic? Rice, of course, yes, absolutely. That makes perfect sense, right? All the fishermen, let's get them together and have, no, it's a disaster.
It seems as if, like, I agree with your point about local banks. When the local economy turns down, the bank goes out of business. But even with securitization and spreading the risk around, that also caused a huge meltdown and crisis too. So, like,
No.
you don't.
No, what okay, what happened, you haven't heard me. What happened is the Muggles okay, I understand that a couple of investment banks went under, a big deal. Most didn't. The PMI industry didn't go under. They saw this coming. Oh, gee, how come all the private mortgage insurance industry didn't fail? Well, the answer is because they saw this coming, right? The problem is exactly, I mean, I could go layer upon layer of problem, but at least initially, that the Muggles insist that they be given a mortgage product which is unsound, and deposit insurance doesn't price risk. Once you make those two mistakes, the die is cast. It's only a matter of when you're going to have the crisis. It's not a matter of whether, okay? So that's what I'm saying. Look, the dot-com bust was bad, right? I mean, people were saying, oh, gee, he has a website and he's selling stuff, right? Let's buy his stock for $100 a share. And how'd that work out? Well, not well, but the point is, when you buy stock on margin, you're limited to a loan-to-value ratio of 35%. So all these people got margin calls. They were sold out. And it was a limited, I'm not trying to say that, 2001 was a great year. But fine. It took care, there was a mania and whatever in an asset. Okay, you see what happens, however, when it's in an asset class where, where we're encouraging people to put 3% down, right? Rather than 65% down. See, stocks, I mean, you understand, in the stock market, our margin requirement is not unreasonable. But we won't impose that margin requirement on real estate. Why? The Muggles. They won't allow it. The Muggles will allow a sensible margin requirement in the State Department, in the stock market or bond markets with broker-dealers. Why? Well, the answer is that the Muggles have no clue. They say, whatever, all right? So I didn't list that as a problem. If the Muggles said you have to allow people to borrow money with the same loan-to-value ratio from a broker-dealer in the mortgage market, and by the way, in the mortgage market, they're providing a government guarantee. To get a broker-dealer to do that, they'd have to provide a government guarantee also. Then I'd be apoplectic about mortgage, margin requirements. But I'm not. It's fine. It's okay. It's not a big deal. Yes?
So about the sophistication of investors, obviously there was a very sophisticated system for analyzing the value and looking at each individual mortgage. But a lot of investors weren't necessarily the investment banks. They might have been an insurance company in the Midwest or a
Well, again, I remember I said if you advise, if you're relying on someone who's not fee-based, then you're a fool. You know, a fool and his money is soon parted. There's nothing we can do. Okay? I mean, people, yeah, well, they make really bad investments. Okay? And absolutely. I mean, I don't know what to say about that, but it's it doesn't bring the economy down, right? But this happens all the time. Okay, I don't know about you, but I get investment opportunities all the time on the internet, right? I mean, I win the Irish lottery or something, the sweeps, whatever it is, at least like once a week, okay? And, you know, I don't pay much attention to that. I mean, I understand but you know, that's an issue way below what we're talking. We're talking about bringing the economy down. You know, what brings the economy down? Okay. But hey, if you want something for the naive, all right, I think I've got one. Oh yeah. Okay, so let's say we think that there's some clueless people. I got just in time for that. Here's something for the clueless. I mean, there's lots of things we could do for the clueless. All right. I didn't go into them because I don't think the clueless people losing money brings the economy down. And that's the main object. Okay. But again, you know, nobody pays any attention to what economists say. I mean, except some people who are political economists and they, whatever, and they have to say what the politicians will allow them to say. It's actually getting so the major hazard to being on the Council of Economic Advisors is they call you in for hearings and then they ask you questions that you either prostitute yourself or you say that what the administration is doing makes no damn sense. And so people have to leave constantly rather than be called in to testify. It's really sad. Anyway, all right. So let's say we wanted to protect Muggles from loan products that were overpriced. Could we do something? The answer is yes. Right. We could offer standardized mortgage products that are priced in a standard fashion. Look, when I go, okay, so I like to be handy around the house. So let's say I'm changing out some bathroom appliances, a toilet or a sink or whatever, right? I go in a Home Depot, and, well, usually somebody's advising me because I can't even be trusted to pick out a toilet in terms of style. All right. Anyway, so I go in there, all right, and I say, all right, what looks good? I buy it. I bring it home and it fits. Why does it fit? The answer is because there's an industry standard of what should fit. Now, if I went to a customized dealer rather than Home Depot, I might get something so fancy it would fit. Or if I bought it in Europe, then there might be an issue. But the point is, it's an industry standard. So everybody can do their own home, whatever it is, right? I used to move furniture during the summer. Furniture that's made in the United States always fits. Fits in the house, comes in and comes out. Because there's a standard. There's an agreement between the builders and the furniture manufacturer that they will build furniture that goes in and out of the house. Period. It works. There's a standard. Okay. There's standards for all kinds of products. Okay. Yeah, we could get the industry together and say, okay, you guys can, if you offer the standard product, fine. You advertise it as the standard product, called the American Eagle mortgage. Okay? Or credit cards. You guys are more into credit cards. Fine. How about the American Eagle credit card? On the American Eagle credit card, all fees, charges, and terms would be a multiple of a single number. The interest rate, we'll say. A single number. So all you'd have to know is it's an American Eagle card, and here's the number, 15%. Here's another American Eagle card, and the number is 20%. You'd automatically know that all charges were 1/3 higher on the second card. All fees, everything. Now, there'd be lots of other cards that were in American Eagle cards. That's fine. That's fine. We have diversity. We have free entry, what have you. But the Muggles would at least know that there was a card that they could buy that was absolutely standardized. And you wouldn't have to regulate it. See? You just say, everything runs off that. You wouldn't need an elaborate disclosure statement with the fine print that I can't read that's written by the lawyers. It would just be standard, right? Period. Oh, gee, why? Well, because you got to be kidding me. That would solve a problem. Right? We actually think the government's interested in solving problems. I mean, not, we're interested in hating the banks, making their life hard. But this is easy to do. There's no problem at all. In the case of FHA, we actually did it at one time. There was a standardized mortgage product, an inspection. A clueless person could go in and buy a house and not be taken to the cleaners. You couldn't buy an unsound house. You couldn't pay above the market price because it would be appraised. And you couldn't pay an unreasonable interest rate. We had all that, and we dropped it. Why? Muggles. Yeah, Muggles. This is easy. It's not a problem. It's not a problem to serve the clueless. Okay? Now, there are people who say, no, we got to educate with disclosure and everything like that. Okay? In order to make good financial decisions, you must be numerate. You must be able to compute the compounding power of interest. The average Muggle is not numerate. They can't do ratio and proportion. They can't do math. It's hopeless to educate the Muggles. But we have, just like it's hopeless, hey, I don't know anything about engineering bathroom fixtures, right? I mean, if it weren't for the standardization, I'd have to always hire a plumber. It's only because of standardization that I know I buy all this stuff, I bring it home, and it fits, right? Now, occasionally I have to wrap on it with a sledge, but it fits, okay, perfectly. And I can do it, even though I know nothing about the engineering behind all that, okay? Well, we could do that for Muggles if we wanted to. It's not a problem. But you understand, you know, this, oh, let's beat up on the banks until they pay us 5% on our CDs and only charge us 4% on our credit cards and still give us a smiling teller and a 90% loan-to-value ratio. And then we'll be satisfied. Okay? You see, it's absurd. Okay? All right. So that's why I like to have fun with it, because otherwise, you know, I might actually get depressed.